Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and or investment strategies recommended and or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. Last week was kind of quiet, I guess. I still can't believe what I've been seeing over the past couple of years in the bond market. We're going to talk about that a little bit later in today's show and what some alternatives are. And there's some really good ones out there now, and they haven't been around for quite a few years. But the risk to the traditional bond approach, which has most investors really upset, because bonds are generally a big part of people's portfolios, and it's really been a drag on the total portfolios, which is not fun. It is just not fun. And when interest rates go up, bond prices have a tendency to go down. And if you're in the wrong bond fund, it's down a lot, not a little bit. I said the past couple of years have been the worst in the past 40. That's mind-boggling. Yeah, so there are some alternatives out there that you can do. I know a lot of people are looking to the stock market, which is fine, depending on what your age is and how much risk you're willing to take. And those two things are never going to change. It's age and, financial position, like how much money do you have relative to the amount of money you need to take out to supplement your income in retirement. If you are more than 10 years from retirement, your portfolio should probably look a little bit different. And if you're 20 years from retirement, it should look a lot different than somebody who is getting ready to turn on that income stream to try to supplement whatever other sources of income they have. So, and that's the hard thing about this. I was thinking about that all week long. I was talking to several clients, and they couldn't be more different. One of them has done very well. I mean, exceptionally well, and doesn't mind taking a lot of risk. Now, they don't have to take a lot of risk. And that's the funny part. Is when we're sitting down and taking a look at the big picture, you've got X amount of dollars. You have this much coming in from. They've got rental homes that they plan to keep running for a while, and you've got this pension income because you worked long enough to qualify for the pensions, and now you're old enough to collect. And quite frankly, they really don't need much at all from their investment. So they can take as little or as much risk as they want to because it's not going to have any impact on their lifestyle. And I can tell you there are very few and far between that ever reaches that point. But the rest of us generally have to have some sort of supplementation from our savings when we get ready to retire. And what that's going to be is really heavily dependent on how much risk you're willing to take. And today, it's we're in a tough spot. There's no other way I can think of it. When I look at valuations on stocks, they're not grossly overpriced. They're slightly, well, when I say slightly, I'm talking about probably 25 to 30% higher than their long-term averages. And depending on which index you're actually looking at, so that would be kind of a minimum. And, if market goes down 25, 30%, it's upsetting. And then people tend to make really bad decisions when the market's down like that. And they make, well, it's just hard. It's very, very, very stressful. And I remember back in 2020, when the pandemic first hit, I'd already had COVID for about 3 months. And then they figured out what it was. And then the market plunged. So, and I understood. I mean, when you have something like that happens, and all the traffic, international trade traffic, slows down, yeah, that's a big um, impediment. Okay, so markets dropped. It dropped significantly. It was down over 35% in about 90 days. You know, wiped out a third in about 90 days. Now, how long has the stock market been around? More than 100 years. So it loses a third in 90 days. That is mind-boggling. Now, it did bounce up, and it is substantially higher than it was when it peaked in 2020. The S&P peaked at right around just slightly under 3,400. Now it's at 4,450, 4,457 to be exact. So it's gone up quite a bit. In the meantime, it peaked in 2022 and is about 8% lower than it was at its highest in 2022. And so, again, markets, if you're going to be looking at markets to supplement your income, you'd better have a minimum of a 10-year time horizon. You'd better not have to touch your stocks for about 10 years minimally, because that's not a guarantee either. I've seen 10-year time periods where the market was still negative, and that's happened multiple times in my life. And I'm not that old. So, in other words, if your life expectancy is 10 to 15 years, there's a pretty good chance it could happen again. So you just have to be on guard against that sort of thing. And that's where conversations that we would have would come into play. Here's how much you have. Here's how much you need to be able to live the kind of lifestyle you want to lead. What's the best, lowest risk way to generate those returns? I am not a big believer in taking unnecessary risk. And I take risk because I've got my money in stocks, mostly stock funds. I have a few stocks, and quite frankly, I'm really close to just saying, you know what? Looking at the stock portfolios, the amount of fluctuation that's present in an average stock, I'm getting kind of tired. I may end up just selling those things and adding them to my ETFs. And thank goodness for ETFs. That was I think God inspired that in somebody. It was such a good idea. And now there are thousands of them, literally. And so I think it's kind of gone overboard that way. You really didn't need all that many. It makes it difficult because there are these things called algorithms. They're mathematical formulas that they use to put together these funds. In the old days, when I first started in the industry, people would pick stocks that they liked and they thought were good businesses that would go on to grow. And the faster the growth is, the faster the share price appreciation tended to happen. And that was all a long time ago. And I just can't believe how much change there has been during that time period. And it's still changed. And when I think back even 10, 12 years ago, which really doesn't seem like that long at all, there were less than half of the ETFs that there are today. Less than half. And when I'm talking to people, they talk about exchange traded funds. They really don't know how the stocks are being picked that go inside the fund. All they know is what the ticker symbol is, and they might know what the dividend yield is, maybe, and they might know the 1, 3, or 5 year track record, and that's it. And that's a little spooky for me because I've seen what happens when that's all your knowledge is, and you go on to make big financial decisions with that. You don't have enough information to make good quality decisions if that's all you know. And I'm sorry if that upsets you, but it's true. And sometimes, we are all subject to this. Truth hurts in a number of different ways throughout your lifetime. But the good news is, all this stuff is learnable, and it doesn't make it. It makes it a little easier. It does make it easier if you really understand why you're doing what you're doing, and you understand what the risks are. Then the worst thing that can happen is you don't understand the risk. You just buy based on the ones that have performed the best in the past. And then in the future, they don't perform that way again. In fact, oftentimes they will go down and lag or do a lot more poorly after they've had a good 2 or 3 year run that put them at the top of the group. And so you get to enjoy that. It's not good enough to know, at least in my opinion, it's not good enough to know which ones finished first, second, and third. I want to know why. Why did they do that? What were the driving factors there? And that's a big deal. And so anyway, I'll leave that alone now. I just got this. I do want to talk about. I just got this. I just subscribed to this software package. I subscribed to it years ago, and it's a product that was written by PhDs for other PhDs, so I'm struggling with it. Because a lot of PhDs forget how to speak English, and they can't. Thankfully, it's one of the reasons I have a job. Yeah, because I will sit down and work at it until I know it inside and out. And I just subscribe to this service, so it may take me 4 or 5 months, working hard to get it done. But it had some stuff in there that I feel like is really worthwhile. And one of those things are building models based on different. They like to call them factors. And so I'll be talking more about that in future shows. Like I said, I just signed up, and it's gonna be incredibly helpful for just about everybody. I mean, it's a big deal, and I'm excited about it, if you can't tell, because it's going to help me do my job so much better. And I'm really, really thankful for that. Now, having said that, it's not going to change. It's not a crystal ball that works. Okay? But you can be much more well informed when you're making those decisions, and that's what I find is that people have a tendency to do the best financially when they've considered everything that could potentially happen, both good and bad, the good, the bad, and the ugly. You get to know that, and the bottom line is if the ugly happens, well, you've already given it some thought, and you already considered what you're going to do before that happened. You didn't know it was going to happen. When it did happen, though, if you're not surprised by it, you're like, oh, okay, well, I know what to do. And that's a big deal. That's a really big deal. And it's the number one mistake that I see other investors make. And oftentimes when they come to me, it's mainly because 9 out of 10 times, they didn't have the time to put into study to understand what the potential outcomes were going to be and why. Okay? But they didn't have the time for that. So they just made a decision without having all the information that they needed, or without having understanding all the information that they needed to understand. And that is the number one problem I see with investors. And everybody wants to take shortcuts. They want to get from A to Z and skip all the letters in between. Me too. I would love to do that. And I did that a lot when I was young. And I got my head beat in enough times that I finally stepped back and said, I think I might have to change my outlook here and change my processes. So I study, and I spent a lot of time studying. And then what I find really funny is you get people who stick with just an opinion. Yeah, I'm only doing stocks, or I'm only doing CD. I just want to keep the money safe. Well, I can tell you flexibility is very helpful when it comes to finances. Unless you make millions of dollars and you don't spend much, and then you don't have kids or grandkids. If you're not in that category, okay, you're probably going to have to spend some time studying, becoming familiar with various markets, investment processes, and even when you are, keeping up with it. It can be it's a lot of work. I can tell you that for sure. I can't believe how many exchange traded funds there are now. It just blows my mind. There really aren't even that many stocks. So there's a tremendous amount of overlap in a ton of exchange traded funds out there. But bottom line is I'm getting too carried away on this stuff. It's good to know, and a good, solid, diversified portfolio probably going to make the investor who's not well educated a little upset at times. They're going to be wondering why am I holding on to this thing when this other one's doing so much better? Well, because at some point in time, that thing that's not doing so well is probably going to come back and have its day in the sun or year in the sun. I got to take a real quick commercial break here in a few seconds. This is Bill Bullington. If you've got a question for me, you can call us 216-901-0945. That's the station's phone number today. You can go to my website and just send me a question. The website is bullingtoncapital.com. And with that, I'll be back after these commercial messages.
When darkness tries to roll over my bones,
Well, welcome back. Yeah. By the way, I've used the Vacation Fixation. That was a company started by one of my clients. His spouse has been very successful. Their website, I think, is pretty cool. I mean, it's very minimal. You just request the quote, fill out your information, and they'll get right back to you. I've used them in the past, and probably going to be using them again this fall. So just give a shout out to those guys, vacationfixation.com. And that's always nice when somebody does a good job, Yeah, that's especially today. To travel, oh my Lord. I was on the phone with Expedia and a couple other, hotels.com, all this stuff. I mean, it was like 2 or 3 days. And I kept going back and forth and getting put on hold, and it's just it's a mess. So next time I'm just calling Vacation Fixation and say, here, this is what I want to do. You guys can sit on the phone. But anyway, so, and I did have oh, yes. We're talking kind of about the stock market and how unpredictable it could be in the short run. The market's slightly overvalued, and it was overvalued by 30% or so before it decided to start falling last year. And then it got down to a point where I'm like, all right, that's right. That's kind of in line where it should be in the long run. Next time I do a seminar, I'll actually go through this stuff and how you can evaluate how overpriced or underpriced the market might be. Now remember, the market can get overpriced and then stay overpriced and get even more overpriced. And those cycles can last for several years. That's what makes investing so tough. is because people think they're doing well and they don't realize, yeah, well, stock prices probably shouldn't be this high, and it's nice, and you can't really tell exactly when it's going to happen, which is why you have to have a rebalancing method in your ongoing money management. It's not all that active, by the way, but you should be able to make some minor adjustments, which are going to make a big difference in the long run if you do it correctly. And you may not have to make any adjustments for 3 or 4 years sometimes 5 or 6 years. But at some point in time, you're going to need to know what you should do if the market does have a really big correction. And some of those moves can really help you out. Now, if you're within 10 years of retirement, you should be doing things to try to avoid having all of your money invested when the market goes through one of those corrections. That's managing your risk. That's a big deal. And I know you guys probably have seen these questionnaires that you don't understand the questions to, and you don't know how you're supposed to answer them. Well, I've got good news for you. I've used the same questionnaire with the one key question for decades, and this past year, some of the biggest firms in financial planning finally gave up their questionnaires, which nobody understood and just confused everybody, and they adopted mine. I knew I should have copyrighted that. But I've been using this forever, and here's what it is. Imagine your money has been cut in half, because if you put all your money in the stock market from March of 2000 to March of 2003, that's what would have happened. 3 years of pain and torture as the market went down, and then it would rally. It would go up a little bit, give everybody's hopes up, turn down and start dropping again, and go to a new low. And that went on for 3 years. At the end of that 3-year time period, it was down 50%. That happened again from November 2007 to March of 2009. That was slightly shorter, was just as painful. Actually, it was probably more painful because it was faster. I don't know. Maybe the faster might be easier for some people. It's kind of like pulling the Band-Aid off fast. But it was another big drop. And so at the 10 years later, 2010, your money was still negative if you had just left it alone. If you just bought it and left it there, it was still in the negative returns after 10 years. That is mind-boggling. It's not the first time it's happened in my lifetime. First time I had to live through it, I can tell you that, because when I was younger and my client base was a lot smaller, we were a lot luckier, and I was able to reduce the amount of decline by a lot, doing a whole bunch of things that don't work anymore. Those things all stopped working, probably 7 or 8 years ago. And which is another thing. Markets continue to evolve. So if you're not really studying a lot, you better. Here's my advice. If you don't want to study and you don't want to get an advisor, and I understand both of those feelings, just put it in the Fidelity's got a balance fund. Just put it in the balance fund and forget it. Don't worry about it. But there are tons of good balance funds out there, and that's basically what we're trying to run. We're trying to add a little bit of value to it. If you've listened to this show at all, you know that we've been overweight the semiconductor industry now for about 5 years, and I started overweighting it before that. I just couldn't roll it out to everybody at the same time, and some people still don't have it because it's more aggressive. It is a more aggressive position, which is why I have a maximum of 10% of somebody's account value distributed between 4 different funds, and that are all invested in semiconductors. Well, that's been the fastest growing industry over the past 5 years, and those funds are in the top 1% over that same time period. And I'd love to say, oh yeah, that was great. I saw that coming. Well, I didn't see it coming. what I saw was companies who were growing their sales faster than they had been growing, faster than any other industry in the world. That's what I saw. That's what was happening at the time. They're still growing faster than any other industry in the world, which is why I still have them. Now, at some point in time, that growth rate may slow down, and then I will probably reduce the holdings in that sector and spread it out under something that's more diversified. So that's my plan. And everybody that's with us here at Bullington Capital, they'll be moving the same time we do. Actually, I have to go last. You know how the captain's got to go down with the ship? That's the same kind of thing. I'm not worried about it. I really don't worry about that at all. It's not going to mean it's not life or death. Would it be nicer to be able to go first and then move everybody else? Yeah, that would be nice, but not allowed to do that. So I like being in business, and I want to stay in business. So I'm going to do it the right way. And I don't even know if or when that may ever happen. Maybe the rest of the economy, and that's the other thing. The economy is growing, and I am flabbergasted at the growth rate that it's been able to sustain despite a pandemic and a major war. That is mind-boggling that we haven't had a slowdown bigger than what has happened because of the impact of those things. It just, I would have never have guessed that. So it's one of the reasons I try to do the things I'm doing with the portfolios. They're not, it doesn't require you to get the future correct. So with a lot of people, if they don't predict accurately what's going to happen in the future, their portfolios are positioned so that they're going to fail. And I didn't want to do that. I want to position my portfolio so that even if I am not right, it's not the end of the world. That I'm still going to survive and can make that back up. It's a big deal. And it takes a long time to learn how to do that, incidentally, just because there are so many investments out there now, and knowing what they do. And I am constantly bombarded with investment products. I probably spend 25% of my time, which is a lot because I spend a lot of time doing this, but 25% of it is reading new products that are coming out. And I'm just flabbergasted that they come out with it. And I'm going to tell you that probably 4 out of 5 of them are not worth it. They're not worth my time. They're doing something I don't think is sustainable in the long run. And that's a long story. I'll stop talking about that now. But anyway, so back to that question that you need to ask yourself as an investor. You need to write down your portfolio value. Just write it down. And you want to include everything that you would be using to supplement your retirement income. So if you got a fund set aside for a vacation, don't include that. If it's a specific vacation, I don't know, destination wedding for one of your kids, something like that, forget that. Just the basic living expenses, the money that you're going to use to support your basic living expenses, write that down. Now, start subtracting from that. Let's say, to keep my math simple, let's say it's $1 million. And market goes down 10%. Well, 10% of $1 million is $100,000. The account balance is now $900,000. How do you feel? If you're ready to take the bridge, well, that means you are a super conservative. Super conservative. And my suggestion is to keep taking away from that until you get to a number where you go, okay, well, I would be nervous, really nervous. My number is 40%. So if I got $1 million and I'm down to 600,000, that's 40%. For me, that's about it. I don't want to be down more than 40%. And that's what I did. I wrote down the amount of money that I have. And actually, I did this a long time. I do it every year. I'll look at it, say, okay, now how much do I want to be down? How much can I actually be down and still be okay with it? Not that I like it, but that I think I can live through it. And that's how we decide how much money we're going to put in stocks versus bonds and cash. And I'm going to get to the bonds and cash in a few seconds here. But back to my example. Let's say my decline tolerance, that's what we like to call it. Let's say it's 30%. Okay? With a 30% decline, if I'm down 30%, I'm upset, but I'm not going to make illogical, emotional decisions. So that's a good number. That means I could have about 60% of my money into stocks or other things that are going to fluctuate a lot. It doesn't have to necessarily be stocks. And the rest I'm going to try to invest conservatively. Okay, conservatively means relatively short-term bonds, not the bonds I was talking about, which incidentally the bond fund index, the aggregate bond index, down 40% from its peak. That's the worst it's been in 40 years. That was relatively conservative, and it was still down a lot because interest rates had gotten so low and have gone up substantially. The percentage increase in interest rates over the past couple of years has also been somewhat of a record. That's only happened one or two other times in the past 100 years. So bottom line is the bond funds that people thought were conservative, they weren't that conservative. They've been watching them get pummeled. And even the conservative ones have taken a pretty decent hit. So my point here is that if you had a 40% decline tolerance, or let's say 25%, I can be down 25%, but I don't want to be down a whole lot more than that because then I wouldn't be sleeping well. Okay, well, 25% equals 50% of 50, right? So I would put 50% of my money in a diversified stock portfolio, however you want to do that. And the other 50%, I'm going to try to stick in stuff that is conservative or considered conservative. And that's it. That's really all you need to do. And it's not always that easy. What's really not that easy is deciding, being honest with yourself about how much risk you're really willing to accept. And if you're married, this is a conversation that you need to have. You need to have this with your spouse because one person may not match up. In fact, occasionally it happens, but more often than not, I'll be talking with a married couple, and one of them has a higher tolerance for risk than the other one does, and that sometimes is a problem. That could be a problem. So you have to find a way of working that out. And I did not know when I got my securities license that I was also going to be a licensed therapist or marriage counselor. Not really. Financial counseling, though, it's a big deal. I mean, it's really it's tough. They didn't teach this in school. Back when I was going to school, I majored in economics, and I took 24 credit hours of finance so that I could get 24 semester credit hours so I could get a minor in finance. And you know what? They didn't teach any of this. I mean, none of it. Mind-boggling when I got into the industry and I started seeing how things actually worked. But hopefully they've fixed that. By now, I have no idea what the schools teach today. But the very, very difficult coming in and trying to learn from the general. We didn't have the internet back in those days, so I was at the library quite often. I got to take a real quick commercial break. I'm sorry I've been rambling on like this. This is Bill Bullington, and if you know me, you know that's probably my style. I've got some really good news when we come back from these commercial messages, so stay tuned. I'll be back in a couple of minutes.
I'll find a way to praise you from the bottom of my broken heart, 'cause I think I'd rather strike a match than curse the dark. Yeah, I'll find a way to thank you.
And we're back. Hey, I've got a phone call. And is this Uncle Phil?
Yeah, how you doing, Bill?
Good. How are you doing?
Can you hear me okay?
Yeah, yep,
Can you hear me?
I can now.
Okay. So, did you hear about the guy? His name is Michael Burry, who made a $1.6 billion bet against the market crashing. He put options on both the S&P 500 and the NASDAQ 100. And this is the same guy that supposedly, called the housing crash back in 2008 and made a fortune. So he's got $1.6 billion riding on the fact that the market's going to tank here within the next 6 months.
So if you're buying put options, did he buy them or sell them?
He's buying put options.
Okay, yeah. So if you're buying put options, yeah, that's a bet that the market is going to go down. And by the way, he doesn't have to be really right on that, because when you're buying put options, you're not actually buying it on the index. You're buying it on a futures contract, and a futures contract will react about 20% for every 1% that the market moves. So he doesn't have to have a really big move to make a lot of money on that.
Mm-hmm.
And that's one of the reasons he's a billionaire, by the way. But he doesn't have to be really right, and he can still be profitable. And to make his cost lower, not that this is easy, but if he's a professional, he's got all those contacts and he's got the kind of money, I'm sure he's got the infrastructure to pull this off. If he watches it along the way, he can actually trade in those options that he's buying and make a profit on those, even if the market doesn't move all that much. Mm-hmm. So you got to be careful. And I know if he would love to see, a good 10 or 15% drop that came in a couple hours. There was another hedge fund manager, man, I can't remember his name. He had done that. He was short the market in 1987. I don't know if you remember, in 1987, the market dropped 20% in a day. It was actually just in a few hours, and it was a computer glitch. They were just experimenting. Well, I shouldn't say experimenting. They were just using computers at that time in a much more heavy fashion, and it really caused a glitch. They had to stop. They had to literally shut the market down, reset the prices, and then open it back up again. So, yeah, I hear about stuff like that all the time. It comes and goes, but you just have to. Pardon me?
I think they say the bet he made represents 90% of his portfolio.
Wow, that's a big bet.
Yeah. I read that.
I hope. Yeah.
What does this guy know
he
that
hedged
we
it?
don't?
Right. By the way, those guys are not required to tell you exactly what they're doing, especially if it's his own firm's money. And if he doesn't have a whole lot of outside investors, even if he does have outside investors in there, there's a lot of leeway there. So you got to be really careful about what you read, especially when it comes to the big hedge funds and the kind of stuff that they're doing. But yeah, so that's interesting. And but I can see why he's doing it. I mean, if he's doing it in that fashion, because like I said, valuations are still extended, and they're still raising interest rates. That's not good for stock prices over the short run. So in the long run, I'm really. It's hard to argue with the growth rate in the long run, and the growth rate's mostly from technology. I doubt that we'll sell a whole lot more cars because the economy gets better, or that more homes will be built and that kind of stuff. But the biggest gains are made in technology and that kind of stuff. It changes so fast and it's improving so quickly that the valuations on a lot of those stocks, they're not bad at all. So,
right.
I never like to see anybody. Go ahead.
No, I was just saying, I just wanted to get your thoughts on that, see if you were aware that that was going on.
Yeah, somebody's always doing that, by the way. Because in order for one guy to go short, somebody else has to be going long.
Right.
And you have to match them up. So
zero sum.
Yeah. Well, thanks. Yeah.
Okay.
Yeah.
So thanks very much. Great show.
Hey, thanks for calling in. Yeah. And if you have a phone call or question that you want to ask, you can always reach me in my office. And my website's bullingtoncapital.com. And you can call us at 330-664-0700. That number again, 330-664-0700. And I'll try to help you the best I can. It's something I have always been passionate about, and it is fascinating. I mean, it's mind-boggling, all the changes that I've seen in the financial services industry over the years. For people like me, it's gotten a little easier. Not easy, but it's gotten easier because there are a lot of tools now that we have that we didn't have before. When I first started in the industry, oh man, the S&P database wasn't available, without spending hundreds of thousands of dollars. And now you can pull up Yahoo Finance and go right to the company's website where all their financial statements are published. So it's just mind-boggling to me. It hasn't made it the psychological part of it any easier. And markets they move a little faster. The ups and downs are pretty close to what they were when I first started in the industry over 25 years ago. But they hit those highs and lows more frequently. And when some big news does come out, market responds a little more significantly than they did from before. But it's always been tough. I could never. There were times when the market kept going up and it seemed easy, but when you compared the valuations, and no, it's always been a pretty tough ride. That's one of the reasons that if you can get a fixed income, this is something I was going to talk about. I'm going to try to talk about these every week because it just makes so much sense. So the example I prepared today was somebody who's going to be 67 next year. They're going to be able to get Social Security. They'll be able to get full Social Security without having to take a penalty for taking it early. They'll be able to make as much money as they want if they continue to work without getting penalized on Social Security. And so for every, so that's good. And if you had $100,000 to invest to supplement that Social Security, you're 66 now, and again, you're going to be 67 next year. That $100,000 you could guarantee an income of $7,154 starting next year. That year you turn 67, we're fully eligible. Now you can do this when you're 60. You can buy these and turn them on. You can invest in these annuities and turn them on at that point in time. And you don't have to be Social Security age. It's just that I just use that because it's a popular date for an awful lot of people. But if you're 66, and let's say you're not going to take Social Security, you're just going to work until you're not planning on taking it until you're 70. But you've got something you'd like to invest in and start taking income from next year to maybe plug the gap until you get to that higher Social Security, because they raise Social Security every year until age 70, and then they stop guaranteeing the increases in it. So maybe you take income from this so that you can put off taking Social Security, and you put $100,000 in. They're going to give you $7,154 starting in 12 months, and that's going to be guaranteed for your entire life. Now, if you got to that, if you're 67 now and you wanted to wait to age 70 before you started taking it, the same $100,000 would generate $9,257. Why? Because you're a little bit older, okay? And you've been in it now for a couple more years. So $100,000 put in there at 67 would generate $9,257. That's a lot. That's a whole lot. And that's from this one product that I like a lot. This is my favorite product. Why? Because they have a pretty good guaranteed income. And what I really like about it is that if you were to start taking income and then you got hit by a bust the next day, okay, there's a return of premium rider on there that you can put on it that your family would get back 100% of everything that you put into it. Okay. If it, let's say you didn't get hit by a bust today, but you got hit by a bust from a year from now, and the market was down, and you had you put $100,000 in there, you took out the $9,200 for income that you were allowed to take. Well, if you had stuck that in a savings account somewhere, there's a pretty good chance that the balance would go to your beneficiaries. In this case, the balance is still going to go to your beneficiaries. That's pretty good. Except that that one had a guarantee to pay a much higher rate. And so bottom line is, you can, if you're looking at something to supplement your income, something that's not going to be in the part of your portfolio that fluctuates a lot, i.e. stocks or stock funds, as a proponent or component of the safer side of your portfolio, these have extremely attractive interest rates, payouts, and they have a tendency to refund the balances. You don't actually give it up to the insurance company when you pass away. It goes to your beneficiary. So if you have questions on that, that's kind of a big deal right now. Again, feel free to call me or go to my website. It's bullingtoncapital.com. And my email is bill@bullingtoncapital.com. So with that, I guess I'll just give my phone number one last time. It's 330-664-0700. And I will let you go. Have a good weekend, everybody. Good luck. Good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and or investment strategies recommended and or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.